This is Mitko Ivanov, the host of the Pum Experience. The Pum Experience is sponsored by Zinc. Hosting a podcast gives you authentic content, engages audiences, and fuels marketing and sales. However, managing it can be overwhelming. This is where Zinc comes in. It's a platform that takes away all the grunt work, allowing you to focus on hosting a great show. To learn more, go to zinc.ai. And now, a few words about our guest today. Nick Bartlett is one of the world's top experts on adaptable logistics for direct-to-consumer and B2B businesses. He is a director and D2C logistics leader at CBIP Logistics. They provide adaptable and carbon-neutral logistics with a value-first focus that supports growing brands' presence globally. Nick is responsible for 100 plus brands shipping over 10 million plus orders. Welcome, Nick. Feeling excited to have you on the show.
Thank you very much, Mitko. It's great to be here, and I think this is the second time you and I have done a show together. So thanks for having me back, and hopefully today we can have a good discussion and share some learnings and some insights about what's happening in the 4PL direct-to-consumer logistics space.
Awesome. Well, why not start with a simple beginning related to DTC brands' advantages and using adaptable logistics. Prior to doing this, let's make also sure like people get to know the expanded version of your story. I know you went to Hong Kong about more than 10 years ago, right? You're originally from New Zealand.
Correct. Yeah.
And what made you make this bold decision and move there?
Yeah, good question. I think probably a little bit dumb and a little bit naive, probably looking back. But I was in my mid-20s. Had a pretty good career path with a big oil and gas company in New Zealand. But sort of had that real urge to kind of go away, live overseas, try new things. So I said to my girlfriend, I said, "Hey, let's go do it. Let's go have some fun. Let's go to Asia, where the world's kind of moving at a faster rate. There's more opportunities potentially across the work that we were doing in New Zealand." And, so at 27, we just kind of packed our bags and we didn't really have much of a plan, to be honest. We just kind of, I think like most New Zealanders, when you come from a small country like I do, with only 5 million people, there's really two options. You either stay where you are or you get out. And, if you get out, you get to explore the world and cultures and different places to work. And that was really kind of our story. It was really quite intuitive to just kind of pack our bags and go. But, fast forward a few years later and, life was pretty settled in Hong Kong and we were having a great time. If you've ever been to the city, it really does offer something quite unique. If you compare it to, say, some of the other large world cities around the world where sort of culture, work opportunities, social life, the sort of expatriate living kind of still lives and breathes really strongly here. And those sort of qualities, I guess, were really kind of attractive to us. And we just kind of ended up, working and sticking around. And then, one day I realized that I was no longer cut out for a corporate life. I kind of had this sort of like just bearing this coming down on me for a long time, feeling like I was almost in corporate prison. It was the only way I can really describe it. I was pretty good at my job, but I absolutely hated going to the office. I hated the monogamy of just the sort of same routine every day, being on the train, like getting off the train. It was killing me slowly. And I remember thinking like, this is what it must be like if you're in prison, because it's like you can't get out. And so I just decided that I was done with that. So I said to my now wife, I said, "Hey, I'm out. I need you to help me. Pay for some of our bills for a while I figure out what I'm going to do." And like any good spouse, she found a way to support us, and sort of forever grateful for that, because it was about, one's mental health and one's own kind of interest in, pursuing something that was more satisfying than just a paycheck. And from there, I couldn't get another job, actually, funnily enough. But I was really interested in retail. I did a lot of work for retail for the oil and gas company. And I was just really interested in the online space of retail and where retail was going, particularly for being in Asia, where retail is such a big part of the sort of the economic layout here. If you think about all the mainland Chinese that come down to TST, and which is a small suburb in Hong Kong, and they shop for handbags and all this sort of exposure that I had to retail, and it was shifting. And so as a result of not being able to get another job, I decided that the best thing to do would just be to hire myself. And whilst that might sound a bit novice, it was probably the best career move I ever made, was because I decided to back myself. I decided to invest in myself. I decided to take a plunge and put some money into an opportunity. And I managed to convince another Kiwi guy that was with me, who I said, hey, man, let's do it. Let's be stupid. Let's go, maybe what should be our house deposit money, maybe we should just put it into a little business idea. And our wives were really supportive. And to be honest, it took us a long time to get any traction and figure it out. But the main hypothesis that we had for the business was that there was a huge amount going on in the D2C space, and there was very strong infrastructure in place in a very traditional capacity. So when I say traditional, I mean like the DHLs, the main freights, the DSVs, all the big boys were here. But there's this whole new, let's call it like a little brother kind of coming up with a completely different attitude and a completely different proposition. And that was the D2C logistics. And the whole feeling was that the traditional industry was going to struggle a lot to handle this new type of logistics when it came down to parcel delivery, pick and pack, single item handling. It felt like these guys just weren't prepared. And so we dug around and we did a bit more research, and we realized that there was a big gap between what was available in the market and what the needs were for the brands that were producing product and selling online. And from there, we kind of tried to marry the business, and that's where we built CBIP Logistics as being an adaptable logistics provider that connects really the very best of the providers in the market that satisfy those needs of those particular brands. Those needs might be, local fulfillment at unit level. It might be international shipping. It might be expertise around customs clearance. It might be even traditional freight movement like air and ocean freight. But the idea was really to sort of be a representative, if you like, for the brands and say to the brands, hey, we can help connect you with some of the very best options and give you options. And that's really where the word adaptability came from. It was sort of like, instead of being a rigid, we're a traditional asset owner in a very fragmented industry, which logistics is, let's be honest. It's very big, it's very fragmented, and there's many hands make heavy work. There's a traditional saying many hands make light work, but my view is actually many hands in the industry make heavy work, because there are too many people involved quite often in a number of logistics workflows. And so our hypothesis was really like, how can we change that? How can we enable a slightly more seamless experience for these brands and these new needs that were coming in? And that's really where the word adaptability kind of came from. And we just kind of played on that for a long time. And fast forward 10 years later, still here, still going, and, trying to make a difference for these 100 brands and these 10 million parcels that we've moved around the world, to make a difference for these brands by being really value driven, by being carbon neutral, and trying to create just fundamentally a different type of logistics experience. And that's really been our whole mission, is to create a different type of experience, not one that you relate to or expect, but one that's like makes you think, wow, that's a really different type of experience. And that's really where adaptability comes from. And I think in the world that we've seen over the last 5-10 years, that world has now become increasingly pressured on adaptability. Brands now want more options. Brands now want to see more flexibility. And so I think, ironically, what we didn't know when we started the business was just where the market was going to go and where those needs from those customers was going to come from. And here we are kind of now sitting in this good little position, but at the same time, all of our competition has also sped up and improved and got a lot better too, right? So it's kind of this sort of catch-22 between trying to drive a new type of agenda, but everyone eventually catching up and realizing that, hey, there's plenty of business here and we need to lift our game if we want to really offer leading direct-to-consumer logistics globally. And that's really, I think, sums up hopefully my background a little bit, but also how I got here and how we came about with CBIP Logistics.
Yeah. Well, thanks for elaborating, Nick. You made a smooth transition to what actually made D2C brand founder to prefer using adaptable logistics, because you went through a few of the advantages as well. Let's speak about 3PL versus 4PL. And a more specific question I have is, what are those elements that 4PL has that people can't get with the 3PL?
So I think, let's start with kind of what is the difference between a 4PL and a 3PL, and that's probably the best place to start. And then we can kind of talk about what does that mean in terms of like some real examples and some sort of like some story that kind of supports that difference in the industry. So in the industry, we have these multiple levels, and we've got a great article on our website, which is sort of what's the difference between 3PL and 4PL. So if you are interested to kind of see some of the stuff I'm talking about, feel free to go to the resource guide on our website, and you can see the article. I think it was posted in March, so just last month.
This is in the blog.
It's a blog, yeah, a blog piece. It just kind of goes into a lot more detail than I might be able to explain on this. But fundamentally, a 3PL and a 4PL, the main difference is that a 3PL is an asset owner. So the major difference between, a material difference anyway, between what a 3PL does and what a 4PL does is that the 3PL, third party, owns the assets. So let's take a really good example of a 3PL. A 3PL is DHL. DHL are a global logistics company. They don't just do parcel delivery. They also do warehousing, transport. They even do ocean freight. They have a supply chain business as well, and they physically, in most cases, they own their own assets. That means they are capitally tied. They are tied from a capital perspective into those assets, and therefore have built a business around the utilization of their own assets. And that's obviously a very capital intensive business. And there's a reason there's only 4 companies in the world like DHL. You've got DHL, UPS, FedEx, and maybe, a few others that kind of get that close. And there's a reason there's only so many of them. It's because it takes a lot of cash to get to that point, to be able to invest in airplanes and trucks and vans and warehouses and technology systems. So, there are many, many examples in the industry of 3PLs. Any sort of household name that you would know or associate with a logistics company that owns something that delivers the parcels to your delivery, to your house or your office, those guys are 3PLs. And they're really the third party option. Now, the next step up is a fourth party logistics provider. Now, a fourth party is an asset light operator. And the fundamental difference is that a 4PL is not intrinsically tied to one set of capital assets. It is only tied to its own interests, which potentially, in our case, for example, we own our own proprietary technology. For example, we own our own customers, our own internal workflows, our own processes and so forth. But we don't own any assets. And there's a material difference here, because instead of selling an asset, which is what someone that works at, say, DHL or DSV or someone like that would do, if a customer came to them and said, "Hi, I'm looking for warehousing, fulfillment, and delivery services," that provider is going to simply sell them the assets that they have got inside their business. Whereas if a customer comes to me and says, "Hey, Nick, I'm looking for warehousing, fulfillment, and delivery options," I can say to them, whereabouts, who to, what sort of product, and we can effectively sweep the scope of their business, so we can look at all of their requirements, and we can present back to them a number of different asset options inside our portfolio of vendors that we work with. And I think the best way to kind of describe it is a bit like an insurance broker, even though I don't really like insurance. I don't really like this comparison, but I guess it helps to understand in practical terms that if you go to an insurance broker and you say, "I'd like medical insurance, life insurance, and home and contents insurance," that broker is going to go away and find you potentially 2 or 3 or 4 different providers that will do each one of those things in their own specialized area. So they might use a specific medical insurer that's very good at medical cover. They might use a house and contents company that's very good with house and contents. And they might use one that's really good for, any other form of insurance that you may be seeking. So, for us, we're kind of like that in that model sense. The biggest difference between us and maybe what would be deemed as a traditional broker is that a traditional broker would broker the deal, cut the scissors, cut the deal, and then they would walk away and move away, right? Now, our model is completely different to that. We control every facet of the operation for and on behalf of the brand that we represent, because we take full commercial and operational liability for every single one of our subcontractors. So that means that if there's an issue with a bill or a delivery or a damaged goods or something of that ilk, that falls directly under our responsibility. And therefore, we go back to back quite often with our subcontractors to our customers. But the major difference in the brokerage comment versus this 4PL asset light is that we fundamentally are able to bring all of the value of these different options together, but managing it for you and controlling it for you inside our own operation. And most importantly, being connected to our own technology, our own analytics, our own pricing, our own data, and most importantly, the overall workflow and the experience. So let's look at like a real case example, right? So, let's look at like a brand, for example, that is producing product in China and is selling from China to the world. And at the moment, they're using a drop shipping model. So they're effectively producing product, dropping it into a warehouse, and then they're shipping it out using a variation of different providers that the warehouse might provide to them. Now, this particular customer has huge demand across a number of different countries. Let's say the US, UK, Europe, Canada, and Australia, for example. And that's the moment they're using one 3PL in China that simply is the asset owner and owns their own relevant carrier contracts, such as like DHL and FedEx and whoever it might be. And every day, orders go into that warehouse, and that warehouse picks and packs orders inside their own asset, and then they sell it out to the world. They ship it out to the world on behalf of the brand. Now, assume that brand comes to them and says, hey, we're really keen on exploring some different options around our supply chain. We like having a China warehouse, but we're also really keen on having a warehouse in Australia, the UK, US, and maybe even Canada, because we want to be closer to our customers. We want to lower our cost. We want to improve the customer experience. Now, that China warehouse is entirely motivated by the performance of their own asset, their own warehouse, right? Their own carrier contracts that they have in place. So, of course, that 3PL in China is going to probably say, we don't have anything in any of those areas, so we can't really help you. But I tell you what, we'll just try and encourage you to stay here because it's better for you, right? Now, that's not really in the best interest of the brand. It may or may not be the right call for the brand. It's hard to know. But for argument's sake, let's assume it's a good decision to migrate a portion of the business outside China. Now, that particular 3PL is tied to their own assets. So they're only going to sell whatever they've got. Now, if they come to me and say, or any 4PL, not just CBIP, but anyone that operates in the same capacity as us, then the whole conversation will be very different. It will be about how can we connect you inside our provider network to support some of these future ambitions that you might have. Let's have a look at some of the analytics. Let's look at the sales performances. Let's look at what the costing of actually picking up stock and dropping it into US, Canada, UK, Europe, and Australia might be, right? And then if we go through that whole process and everything looks really good, we can then present to the brand a number of different provider options that are integrated into CBIP's technology that they can work with to get access to all of these different options. So it's a really big fundamental difference between the restriction, or what I kind of call like the ceiling. A 3PL has a ceiling on their head because they can only do what's inside their own assets. Whereas a 4PL is kind of, we don't own the asset. So that's actually a negative thing for us. Like, we don't own the building, right? So a lot of brands, they want to work with the guy that owns the building. And I understand that and I respect that. But a lot of brands also need adaptability, and they need options, and they need more than what the limit of a 3PL can offer. And that's really where a 4PL comes in and is that kind of control tower, manages and offers you adaptability and options to the market, and effectively and hopefully will help you grow into places that you wouldn't otherwise have thought you could get into, unless you, as the brand, were willing to manage maybe 2 or 3 or 4 of your own 3PL relationships.
Right. Much more options, much more flexibility with the 4PL, obviously. And especially for brands interested in doing some form of expansion to new markets, this seems to be the right choice. And talking about expansion to new markets, let's make this smooth transition. And what makes me really excited is a blog post I read recently on your blog. So it should be cbiplogistics.com/blog, One of the articles, I can't recall who wrote that, but it was like 5 hot markets to expand to in 2024 or something very similar.
Yeah, that's
So
right.
let's go through the expansion to new markets as a talking point.
You know, the pandemic proved two things, right? It proved that when people were at home and didn't have much to do, they went mad online. That's the first thing it proved. And the second thing it proved was that there is kind of capacity. If everyone's got an element of capacity inside their own main markets. So what I mean by that is like eventually everyone gets to a point where you can't sell more than what you've already sold unless you try other ways of selling it. E.g., you might move from online to a retailer like Walmart or something, right? But in most cases, a brand does have its limits, on how much it can saturate the market and how much it can push through on sales volume in one specific market. So, those two things is kind of what COVID taught us, is that, you can boom up really big, but at the same time, you can kind of be a bit limited on how much saturation your product actually has to grow inside of one market. So, when we look at what's happened post-pandemic and we look at kind of, how are brands now behaving, and the number one thing we've seen is that in the primary dominated markets for a lot of brands, their domestic, like their main market, let's call, they've seen a decline in sales in most cases, right? Because, the COVID obviously was like right up the top, and then it's just kind of slowly peaked back. And that's happened because demand has come off, exposable income has probably come off, interest rates have gone up. There's been a whole bunch of other things that are affecting people's purchasing power. But as a result of those changes from post-pandemic, it presents a great chance to look at saying, okay, where else could our product land really well that we haven't explored so far? And let's do some research as to how well we think our product might sell in some of these other markets. And we've got a number of great case studies where businesses that you would probably look at and think they could just sell to America and they'd be fine. And yet they've done that and they've done really, really well, but they've realized that there's a bit of capacity, there's a bit of saturation there. And they're starting to look at places like Japan, Korea, mainland China, Taiwan, particularly out here in the East. We've seen a lot of shift of volume this year towards the East. And that's because these brands are starting to realize that there's more, there's more work that you need to do. Of course, if you want to sell to a new market, you have to be invested in the effort to do it. But most importantly, there's a huge amount of opportunity outside those primary markets. So what we did was we looked at a number of different markets based on the growth rate of e-commerce in the country. We looked at the existing infrastructure in those countries. So how good is e-commerce logistics to support? So how good is local delivery, returns, pick-up, drop-offs, all of that. We looked at kind of that logistics infrastructure. We looked at the current size of the market. So how big is the population? How much appetite would there be for more products that are maybe not readily available? We looked at the penetration rate of the internet. So how well is the internet actually performing per capita? And then we looked at, any government or regulatory impacts that are either positively pushing people to bring product in from a cross-border e-com point of view, or maybe inhibiting it, not helping it in such a way. So when you look at those kind of 5 criteria, there were 5 markets that we found to be really favorable, that from our research, that looked favorable to enter into. Now, of course, this is not a blanket, any product will work in these countries. This is more of a aggregate view of a cross-section of different product verticals, and then kind of looking at these 5 factors around growth, penetration of the internet, government regulation, etc. And we saw that South Korea, Japan, Japan's actually not on our article, but I'm going to mention that today because we've seen some good interest in Japan this year as well. Vietnam, and then looking sort of, that's in the East. And then for the more Western markets, Canada, surprisingly, despite its proximity to the US, is massively undertapped. And this year alone, we've seen about half a dozen customers all move significant volumes, either cross-border into Canada or actually set up an operation inside Canada to service domestic volume inside Canada. And South America, Mexico, predominantly Mexico. And then the other interesting one, the UK, which again, you would probably think, the UK, it's pretty dense, it's got very good infrastructure, 1-2 day delivery. Like I can tell you right now, there's a shitload of e-com brands in the UK that are struggling. But I'm talking about bringing your product from overseas into this market. And we've seen a couple of really good examples. I think one that's done really well is a beauty and cosmetic brand called Lashify. They're a big American brand that we support. They moved a whole operation into the UK, and they saw a huge amount of upside that came from being closer to the customer, tapping into a market that was kind of there in the background. They kept getting good penetration, but they weren't really converting on it. And now they've really gone about and strategically and set up a very strong expansion into that market and are now fulfilling local orders. So effectively have completely localized the experience for those customers in those markets. And yet it still only makes up a relatively small percentage. But the most important thing is that it's enabling them to enter into a new market without really that much extra hassle. And, yes, there's things you have to do to enter into a new market, like VAT registrations and companies, set up. And, I'm not going to pretend it's all rosy. It's definitely easy. It's definitely got its hard part. But most importantly, these types of brands have proven that actually where you probably thought, is there that much demand? They're actually generating really good case study to say, hey, we are a mature US brand, but we're actually looking to expand, and they're getting good results as a result of making those strategic decisions to get into those markets. And that's a really good example of what we've seen and how we've identified these 5 markets that we believe to be probably the strongest, particularly in the context of mostly North American brands that have potentially kind of just like run a little bit of their gauntlet. They've kind of gone a little bit, they've done really, really well, but they're now seeking, hey, how do we grow sustainably and smartly without just relying on our own backyard? And I think sometimes, the Americans can see America for being the world, and it is a very big market, and that's totally cool, right? And that's totally okay. But fundamentally, there's, whatever it is, 6.5 billion other people or whatever the number is, that are also could be keen on using their products. And we're seeing some great case studies of brands that are making really conscious decisions to expand in these markets that I've mentioned, in our opinion, and from the research that we've done across, an aggregate of product verticals, potentially do make good sense. There's another really good example of a European brand that's come into Japan, Korea, and mainland China, and they're just killing it. It's a keyboard product. You probably wouldn't, if you're like, again, sometimes I try and put my brand hat on, and I wonder, how would I, if I own this brand, would I think to sell to the Koreans or the Japanese or the mainlanders or the mainland Chinese? I don't know. And then you start selling it, and you start seeing that they love your product, and all of a sudden you're unlocking this whole other world that's, mainland China is 1 billion people just on its own. So you only need a very small percentage of people to buy from you, and all of a sudden you've got a market that's 4 times bigger than the US, and 3.6 times bigger or whatever it is, and you're opening up a whole new door and capacity for your brand, and the future that it might be able to achieve.
Right. Well, CBIP Logistics is offering different types of options for brands to expand, right?
Yeah, that's right. Yeah, so depending on the nature of the product, the customer, all around your customer promise, the experience that you're trying to deliver for the brand, with the brand, we look at all facets of what you're trying to achieve, and then we simply provide you with a suite of some options that you can look at. Of course, we have some preferred options that we submit in certain markets because they're tried and true and they perform really well. And, so for example, if you're entering into the UK, we have, 3 great UK warehouse operations that we work across. And, we would present all 3 of those to you. But most importantly, we absolutely give you the options, and we bring the expertise around how to actually get into these markets. Some of them, obviously, we're less knowledgeable about in terms of getting, like if you wanted to establish domestic operations, such as places like Japan, South Korea, those are more difficult markets. But certainly from a cross-border perspective and leveraging a hub like Hong Kong, and I guess this is kind of probably the second side of the story, is that a lot of brands that are seeking expansion are actually doing it smartly through free trade ports like Hong Kong, bringing product in here, setting it free, letting it sit here for free with no duty impact because there's no duty or GST or VAT or sales tax here. And it means that, you can then make yourself readily available out to the Eastern markets if you wanted to. So it's a really conservative way of kind of starting without actually taking too much risk. It's like, let's just drop in a few pallets of stock. Let's start testing some marketing through our digital ad spend or however you're promoting to your customers. And then let's see what the sort of funnel conversion looks like. And then if we start seeing that, we're getting orders for Australia, South Korea, Japan, Taiwan, all of these markets can be fulfilled very cost effectively from Hong Kong. And all of a sudden you're opening yourself up without even having to really go into setting up a domestic market for each one. So, that's the benefit you get from working with someone like us, is that we're going to open you up to those ideas and those sort of, options for your brand, and you can consider it. But we'll also tell you what we think if the brand's not a good fit for a market, if we think it'll be too difficult, if there's certain characteristics of certain products that we can speak quite freely and candidly on as to whether or not we think would be achievable or successful or not in those respective jurisdictions.
Well, this is quite insightful, Hong Kong being the center of
Asia. It's kind of lost, it's lost a lot of its it's lost a bit of its kind of reputation in some senses, because people of, the Greater Bay Area has opened up so significantly. It's a lot easier now to ship just directly out of China. Stuff doesn't funnel through as much as it did. But I think actually if you put the shoe on the other foot, which is actually bringing goods in to Hong Kong to then distribute out into the region, that's actually really the role of Hong Kong. Whereas once upon a time, it was much more of a cross-dock, China into Hong Kong, then out. And that's still happening, of course. But I feel like now it's kind of it's going to be about how does Hong Kong play sort of almost a re-export role, where things come in and then kind of go back out into other markets for the brands that they wouldn't have otherwise have gone. Our volume is still very westbound heavy. It's still very, Hong Kong, China, US, Hong Kong, China, UK, Hong Kong, China, Europe. But in the next 5 to 10 years, I think our business will shift from being maybe not 80-20 to more being like 50-50, where we're doing 50% into the region, 50% up to the western bound markets. And that'll be for two reasons. One, brands will obviously dilute some of their domestic sales in an effort to try and grow into new areas, into new geographies. And the second thing that will happen is that a lot more businesses will start going to a domestic model position, where they will pick up stock from China and they'll drop it into a more localized fulfillment program. And we're already seeing that happen. And you could argue that it's a bit cyclical, and there might be periods where that's more popular, and then it comes back into more of a consolidation type arrangement. But my view is that the customer, the consumer, is the one driving what happens in the industry, not the brand or the logistics company. So consumers are seeking speed, fast, positive experience, easy returns, and that's very difficult in an international cross-border environment unless you're a high premium product and you've got significantly solid volumes to really support a cross-border business. If you don't, I think a domestic model is a much superior option. Even if it costs you a little bit more in the long run, you're probably going to have a better success of building a more sustainable business.
Understand. Well, look, that was a nice example of what's achievable for brands willing to expand to Asia and also some other markets you covered. Let's also cover sustainability, where it comes for brands. Is it a must nowadays, or is it still a choice?
Yeah, look, I think this is a really tricky one, because everyone's got such a different opinion about this, right? And that's healthy. Our view is that we're driven by what we make decisions as a 4PL based on what we see that consumers are doing. We don't really make them based on what our industry wants to do or what even our brands are necessarily dictating. We're really trying to look at the data from a consumer perspective, and what are the trends around purchasing that are coming, and how can we prepare to support those trends for our brands. And that's always been quite a big focus of ours as a business, is to be more that, like, thinking more like that rather than inward around kind of what do we want to do. And the big thing that supports that is that customers, those consumers, they want carbon-led, sustainably neutral at a bare minimum logistics. Not necessarily the logistics side exactly, but they want to buy from sustainably led, smart, conscientious brands. And to be perfectly honest, we really like working with brands that are really well aligned to that, because we are aligned to that. We're a fully carbon neutral provider across all of our operations. So it's very rare for a provider like us to actually have this type of carbon commitment, because obviously we use a whole bunch of third parties as well, right? We use subcontractors, and a lot of those subcontractors also offset. So let me give you a good example. Someone like DPD in the UK, they're a local last mile delivery company. They offset all of their delivery parcels, and so do we. So effectively we're double offsetting those parcels, because DPD offset it and then CBRP offset it. So that means it's actually kind of carbon positive for those particular parcels. So, for us, we've kind of got this really unique position that we are not just offsetting the delivery, we're offsetting the warehouse, the ocean freight, the air freight, what happens here in our offices, we offset, our international travel, we offset. We try and take a really holistic position around our carbon footprint. And look, we are a dot in the ocean, right, compared to the big boys. We are not, we are bottom of the profit center contribution. We're really small. But the good thing about that is that we're setting up a standard for the future, which I think both we really are aligned to, but we also know that consumers are aligned to too. So yes, not everyone's going to care about it. Yes, it's still going to take a while for brands to accept that maybe it's something they have to do. And you know what? Some brands are very, very proactive and very supportive, and they love the fact that we do it. And then there's brands that say, hey, it's great that you do it, but we don't really care. But that doesn't stop us from doing it anyway, because it's the right thing to do. We've got young kids. I want my two sons to grow up in a world that was the world that I knew, clean water and clear skies. And, I can't imagine, them coming to a point in their life where those things are not there. Now, granted, I grew up in a very beautiful part of the world, but still, an element of me kind of holds a lot of that. What we see is important in the world, and that sort of sustainability positioning is reflected through our DNA as a business, and we're just trying to do our bit. But certainly, there are plenty of good case studies for brands that are partnering. We see brands kind of doing two things. We see brands doing a lot of good stuff themselves around their own ESG. And then we see brands also doing that good stuff, plus partnering with like-minded sustainability suppliers, whether that be like packaging suppliers or logistics suppliers or, carbon calculation companies, to help actually calculate all their offsets, whoever it might be. There's a lot of good alignment on that. And I think, we've worked with a number of brands that are doing that, and are doing a really, really good job at doing their own initiatives, but then finding partners that support those initiatives too. So then they can really tell a story to their customers that's authentic, it's credible, and it's completely honest. Because let's be honest, there's a lot of greenwashing that goes on in sustainability. And if anyone wanted to see our sustainability efforts and what we physically do, I will show someone our audits, I'll introduce them to our audit partner, I will show them the documentation, whatever is required to ensure that people understand that it's not just an easy thing to say, because that's my big fear, that it's an easy thing to say, but the delivery is not there. So the proof is always in the pudding, and I think the future for sustainability and logistics is positive, but it's just whether or not the brands will buy into it to meet the consumers' needs in the future.
Oh, awesome. We went through a couple of important subjects. Now let's just wrap it up for the listeners who want to learn more and start a conversation with you and check what are their options to expand and to diversify, the way they deliver products around the world. What would be the one thing they need to do to get in touch with you, to get the right offer? Is there a certain place on the website they need to go?
Yeah, look, obviously you're welcome to reach out to me personally. I'm sure my details might be at the bottom of this of this link for this podcast, but that's, I'm certainly happy for you to come directly to me. That's fine, and I can commit you out to my team. And then the other way is just through our website. We've got some clear CTAs there that you can call to action and email us, and we have a 24-hour turnaround on responses. So our team are pretty diligent on that as well. And of course, you can follow us on LinkedIn. We're constantly posting some really helpful and insightful information that's more around our experiences and what we're seeing. Because, like I said, as a 4PL, we're not really representing anyone really apart from the brands that we represent. Really, like we're kind of taking a mixture of all of the intel and the information that we see in the market and kind of creating content around that. And yeah, you can subscribe to our newsletter. You can follow me on Twitter if you want to see some of my cheesy Twitter anecdotes as well. So yeah, look, we're on a few different places, but of course, any commitment to reach out will certainly give you some time, and we'll certainly look at how we might be able to help you. We may be a fit for you, we may not be a fit for you, and that's okay. We're pretty honest about that. But certainly we're always keen to have a chat and see if we could be of any help.
Awesome. Well, thanks, Nick. I can also see that the blog is cviplogistics.com/en/posts. En
Okay.
obviously comes for English, but I see your website is also translated in Chinese
and Vietnamese.
Yeah. Vietnamese, yeah, awesome. With plenty of valuable content here as well. Well, once again, thank you for elaborating on what makes a brand sustainable nowadays. What are their options to expand to new markets? And what are the real advantages for D2C brand founders in using adaptable logistics? Well, thanks, and looking forward to chat again soon.
Cool. Thanks so much, Mitko. Great to chat, and thanks everyone for listening.